Something is about to happen that almost no one in mainstream financial media is talking about. On May 12th, the Bureau of Labor Statistics releases the Consumer Price Index, the single most market-moving data point in the entire financial calendar. And this time, the stakes are different. This time, the number doesn't just determine whether the Federal Reserve cuts rates or holds. This time, it determines the fate of one of the most explosive trades in the metals market right now, silver, a metal that has already moved more than 40% in a compressed window. A metal sitting at a technical and fundamental crossroads that seasoned traders recognize as genuinely rare. And the range being quietly discussed in institutional circles is staggering. Some desks are pricing in a move to $85 per ounce. Others are hedging for a collapse toward $70. Both outcomes flow directly from what that CPI number says, and more importantly, what it implies about the path of real interest rates, the dollar, and the global industrial demand cycle that almost no one is factoring in correctly. This is not speculation for its own sake. This is the architecture of a trade that is being positioned right now by people who move markets. Let's build it from the ground up. To understand why silver is sitting at this exact inflection point, you have to understand what silver actually is. Most retail investors make a fundamental cognitive error with silver. They look at it as a cheaper version of gold, a poor man's store of value, a hedge against inflation dressed in slightly less prestigious clothing. That framing misses about 60% of the actual silver market. Silver is a dual asset. It exists in two worlds simultaneously. In one world, it is a monetary metal, ancient, politically neutral, sensitive to real interest rates and dollar dynamics the way gold is. In the other world, it is an industrial input, a critical one. Silver has the highest electrical conductivity of any element. It is irreplaceable in photovoltaic solar panels, in electric vehicle charging systems, in 5G infrastructure, in advanced medical technology, in defense electronics. The Silver Institute has consistently tracked industrial demand accounting for more than half of total annual silver consumption, and that share has been growing, not shrinking. This dual identity is what makes the May 12th CPI print so uniquely explosive for silver specifically. It's not just that CPI moves rates and rates move metals. It's that CPI is landing at a moment where both of silver's personalities, monetary and industrial, are simultaneously under stress. That's the rarity. That's why this setup is different. Now let's talk about where silver actually is right now as this script is being written and as you're watching this. Silver has had an extraordinary run from the low 30s into the low 50s over the past 18 to 24 months. That run was driven by a combination of factors: Fed rate expectations shifting, dollar weakness in key windows, the ongoing solar build-out absorbing physical supply, and a retail investment wave that brought new participants into the market. But the run has not been linear, and it has not been without turbulence. Right now, silver is caught in a consolidation zone that technical analysts are reading in contradictory ways. The bulls see a high-level base formation, a compressed range after a major move, which historically precedes the next leg higher. The bears see distribution, institutional hands quietly lightening positions into retail strength. Both reads are defensible. The chart alone cannot resolve this. What resolves it is the macro catalyst, and the macro catalyst arrives on May 12th. So let's talk about CPI. What is it actually measuring, and why does the specific shape of this particular print matter so much? The Consumer Price Index measures the average change in prices paid by urban consumers for a basket of goods and services. That basket includes housing, food, energy, medical care, transportation, and a range of other categories. The headline number gets the attention, but traders, real traders, read the components. They read shelter inflation, which has been the stickiest and most distorting element of the CPI calculation for the past 2 years. They read core services ex housing, which is the Federal Reserve's preferred internal signal. They read goods deflation or reinflation, which tells you what global supply chains are doing. And increasingly, they watch energy, because energy is both a direct inflation input and a proxy for global demand conditions. The Federal Reserve has a dual mandate: price, stability, and maximum employment. They have been navigating a genuinely difficult environment in which inflation came down faster than almost anyone expected, but has now re-accelerated in certain components. The labor market has shown surprising resilience, but leading indicators of hiring have been softening, and the global backdrop has shifted meaningfully, with trade policy uncertainty reintroducing supply-side cost pressures that the Fed explicitly did not create and cannot easily cure with interest rate policy. That's the environment into which May 12th arrives. If the CPI print comes in hotter than expected, and by hot, we mean headline above 3% annualized, or core above 3.2, with shelter showing renewed acceleration and goods prices turning back up, the market will immediately price out any remaining probability of Federal Reserve rate cuts in the near term. Real interest rates, which is the nominal rate minus inflation expectations, would likely rise not because nominal rates rise, but because the market's inflation expectations get re-anchored lower relative to the rate path. A higher real rate environment is structurally negative for gold and silver in the short to medium term. The dollar would likely strengthen on rate differential dynamics. Risk assets would face selling pressure, and silver, which has already had a massive run, would be vulnerable to a technically meaningful pullback. That's the path to 70. Not a crash driven by panic. A repricing driven by rational adjustment of rate expectations in a hot inflation environment. But here's the other scenario, and this one is more complex and more interesting. If the CPI print comes in cooler than expected, headline below 2.6, core below 3, with shelter beginning its long anticipated deceleration and goods prices remaining contained, the market reprices the rate path dovishly. Probability of a 2025 cut gets pulled forward. Real rates fall, the dollar softens, and silver gets a green light on its monetary dimension. But that's only half the story. The cooler CPI scenario carries an industrial implication that almost nobody is modeling correctly. A softer inflation print, in the current global context, likely means one of two things. Either domestic demand is weakening, or the global disinflationary impulse is reasserting itself through cheaper imports. If it's the former, weakening demand, that's actually a mixed signal for silver's industrial use case. Weaker economic activity means less construction, less manufacturing, potentially slower solar installation rates. The monetary tailwind would be real, but the industrial headwind would partially offset it. That's a moderate bull scenario. $30, $40 moves, real but not explosive. The truly explosive scenario, the $85 scenario, requires something more specific. It requires a CPI print that is soft enough to validate rate cuts, but not soft enough to signal genuine economic deterioration. What traders call a Goldilocks print. Cool inflation, but with a services sector that's still running at a reasonable pace, energy prices stable, and no sign that the consumer is collapsing. In that environment, you get dovish rate repricing without a growth scare. Real rates fall, the dollar softens. And silver's industrial demand thesis remains intact. Both personalities of the metal get a tailwind simultaneously. That is the setup for a genuine breakout. Now, let's add a layer that almost no mainstream financial commentary is incorporating into this analysis. The global silver supply picture is tightening in ways that are not widely understood by retail participants. Annual silver mine production has been roughly flat to slightly declining relative to demand growth for several years. The above-ground stockpiles that historically acted as a buffer, the large government and institutional hoards of silver that could be mobilized to meet demand spikes, have been drawn down significantly over decades of industrial consumption. Unlike gold, which is almost entirely recycled and accumulated above ground, silver is genuinely consumed. When it goes into a solar panel, it doesn't come back easily. When it goes into a medical device or an advanced circuit board, it is effectively removed from the monetary supply. This structural tightening is not a new observation. The Silver Institute and various commodity research houses have been tracking it for years. But what's new is the acceleration on the demand side. The global energy transition, specifically the build-out of solar photovoltaic capacity, is consuming silver at a pace that was not fully anticipated in projections, made even 3 or 4 years ago. Solar panel manufacturers have been working to reduce silver content per panel through thrifting technologies, and they have made real progress. But the overall volume of panels being manufactured has grown faster than the per-unit silver reduction. The net result is that solar's silver demand has grown, not shrunk. China's domestic solar build-out alone has been absorbing meaningful quantities of silver. India's renewable energy ambitions require silver. The United States Inflation Reduction Act has catalyzed domestic solar manufacturing investment that will require silver supply for years. These are not speculative projections. These are contracted projects with financing and timelines. Against that backdrop, the May 12th CPI print is not happening in a vacuum. It is happening against a supply structure that was already tightening before the macro catalyst arrives. That asymmetry matters for how you think about the risk-reward of silver at this inflection point. Let me now walk through the institutional positioning picture, because this is where the psychology of this trade gets genuinely interesting. The Commodity Futures Trading Commission publishes the Commitments of Traders report, the COT, and weekly. This report shows how different categories of market participants are positioned in the silver futures market. Commercial hedgers, who are typically mining companies and industrial users, asset managers, who represent institutional capital, and leveraged funds, which tend to be trend-following systematic traders. Reading the TOT correctly requires understanding who is doing what and why. In periods leading up to major macro catalysts, you often see a specific pattern emerge. Leveraged funds build long positions, riding momentum. Asset managers maintain more measured positioning. And commercials, the smart money with actual industry exposure, hedge their physical exposure through futures shorts. When leveraged fund positioning becomes very crowded on one side, you get the conditions for a violent reversal if the catalyst disappoints expectations. The The unwinding of a crowded long trade in silver can be fast and brutal because silver's market is not as deep or liquid as gold. If May 12th delivers a hot CPI print and those leveraged longs unwind simultaneously, the move toward 70 becomes not just likely, but potentially self-reinforcing. Stop orders cascade. Liquidity thins. The metal overshoots to the downside before any fundamental buyer steps in to stabilize it. Conversely, if the CPI print is Goldilocks and those same leveraged funds add to already long positions while new money comes in, the move toward 85 also becomes self-reinforcing. Silver has a history of these explosive moves precisely because its market is thinner than gold. This is the dynamic that makes this particular catalyst so high stakes. The positioning amplifies the macro signal. The CPI number doesn't just matter because of what it means for real rates. It matters because of what it does to the positioning dynamics in a thinly traded market with structural physical tightness underneath it. Now, let's talk about what you actually do with this information. Because the purpose of understanding this framework is not to make a reckless bet. It's to think clearly about risk and reward. There are several ways that thoughtful investors and traders are approaching this setup. Some are holding existing silver positions but tightening stop-loss levels beneath key technical support, allowing participation in the upside scenario while limiting exposure to the downside cascade. Some are using options to express a directional view while defining their maximum loss, buying call options that profit from a breakout toward 85, or buying put options that profit from a flush toward 70, with the understanding that the options market may be mispricing the magnitude of the potential move. Some institutional players are simultaneously long physical silver and short silver futures as a pairs trade, capturing the spread between physical and paper markets that tends to widen during moments of stress or euphoria. And some are simply watching, waiting to see the print, waiting to see the initial market reaction, and positioning afterward, accepting a slightly less favorable entry price in exchange for confirmation of the direction. That is not a cowardly strategy. In a binary catalyst environment, waiting for confirmation is often the highest expected value approach. What none of these approaches involves is treating this as a sure thing. Nothing in macro markets is a sure thing. The CPI print could surprise in ways that nobody is modeling. The Fed could signal something in the minutes or through a speaker that complicates the interpretation. A geopolitical event could dominate the tape and temporarily overwhelm the macro signal. Markets are not machines that follow scripts. They are aggregations of human judgment under uncertainty, and they surprise even the most prepared analysts regularly. What disciplined analysis gives you is not certainty. It gives you a framework for understanding the probability-weighted range of outcomes, positioning your exposure in alignment with your actual risk tolerance, and avoiding the cognitive traps, recency bias, narrative fallacy, confirmation bias, that cause most retail participants to buy tops and sell bottoms. Let's zoom out for a final moment before we close this analysis, because there's a larger picture here that deserves to be stated clearly. Silver sits at a unique intersection in the early 21st century economy. It is a relic of the ancient monetary system. It is a critical input for the future energy system. It is a market that is simultaneously shaped by central bank policy, industrial supply chains, retail sentiment, and institutional capital allocation. Very few assets carry that kind of complexity. Very few assets offer the kind of leverage to multiple simultaneous macro themes that silver does. The May 12th CPI print is one node in a longer story. Whether silver breaks to 85 or flushes to 70 in response to that print, the structural tension in the silver market does not resolve on May 12th. The solar demand continues, the supply constraints continue, the monetary dynamics continue to be shaped by central bank decisions that are themselves shaped by inflation data. This is an ongoing story, not a one-day event. But May 12th is a legitimate inflection point. The data will either validate or challenge the dominant narrative that has driven silver's multi-month run. The positioning will either get rewarded or unwound. And the market's reaction will tell you something important about where the next phase of this story is headed. Pay attention to the number. Pay attention to the components, not just the headline. Pay attention to how silver reacts in the first 60 minutes after the print, because that reaction often reveals whether the positioning was already priced in or whether new information is genuinely shifting expectations. Pay attention to what the dollar does simultaneously. And pay attention to whether gold and silver move together or diverge, because a divergence between the two metals in response to the same macro catalyst would be telling you something important about which of silver's two personalities is driving the trade at that moment. The metals market is speaking right now in the language of price, of volume, of open interest, of options skew, of physical flows between vaults and industrial users. Learning to read that language, calmly, rigorously, without letting the noise of financial media crowd out the signal, is what separates investors who navigate these moments well from those who get caught on the wrong side of them. May 12th is coming. The CPI number will land. The market will react. And whether that reaction confirms the bull case for 85 or triggers the flush toward 70, you will be better prepared for it, having understood the architecture of what is actually happening and why. That is always the goal. Not predictions, not certainty, not hot takes, understanding. Watch the print, trust your framework, manage your risk, and stay sharp.